It's right 9 o'clock, so we're going to roll. Welcome, everybody. I'm Carrie Bass, the CFO of Stark Community Foundation. We want to thank you very much for joining us today. As usual, we have a few quick housekeeping items before we get started. Just a reminder, audio and video for all attendees has been turned off by default. So we encourage questions, and if you do have those, please submit those through the Q&A or the chat box, and we will do our best to monitor those and respond as time permits. In today's webinar, we're going to have a market update for you, as well as an overview of artificial intelligence and the impact it has on the markets. As we all know, AI continues to dominate the headlines. Just this week, we've heard a lot about Amazon cutting 14,000 jobs, and they've tied that directly to AI. I think, to quote, they said to be leaner in the age of AI. So, grab a cup of coffee, settle in. I think we're going to have a lot of good information and data to share with you. So without further ado, it's my pleasure to introduce again this year Chris Caparelli and Evan Frazier, both with Marquette Associates. Marquette's been our trusted investment consulting firm for over 6.5 years now, and we're happy to be partnering with them and have them here today to share their expertise for all of us. So I will turn it over to you, Chris, and thank you.
Thanks, Carrie. Good morning, everyone. Nice to be with you again, as we've done the last few years. Really looking forward to the chance to speak with you all. As Carrie mentioned, I'm here with my colleague, Evan Frazier, this morning. Evan's on our research team, and I'll try to leave plenty of time for Evan to talk because he's going to cover the meat of the subject matter today, which is that artificial intelligence theme. It has been such a big sort of dominating force in markets and in economies the last number of years, and it looks like it's going to continue down that path. So I think it's a really important topic, and we've got some good information on that front to share. Before I turn it over to Evan, I'm just going to remind you really quickly kind of who we are at Marquette and what we do. I'll spend a few minutes talking through the current market environment, sort of outside of AI, as we think about just traditional stocks and bonds and economies and sort of all the data that we look at that goes into portfolio construction. And then I'll turn it over to Evan to run through the artificial intelligence slide. So that's our agenda for the morning. Again, just to give you a quick reintroduction to who we are at Marquette. As Carrie mentioned, we've been lucky enough to work with the foundation for a good period of time now and have really enjoyed the relationship and are thankful for it. We work with a lot of organizations like Stark Community Foundation around the country, not just in the nonprofit segment, but we work across a bunch of other institutional client types. We have about $420 billion in assets under advisement. We're 100% employee owned, Chicago-based, and about 150 employees. The nonprofit segment of our business is the largest, and it is the fastest growing. We're fortunate to work with some really great organizations here that you see kind of some logos on the right-hand side of the page. And I think, there's a lot that goes into the work that we do, but I think one of the things we're most proud of is that we tend to build really long-term relationships with our clients. We're 6 years in here with the Community Foundation and plan to have a lot of good years after that. Our average client tenure is over 10 years at this point, and it's just great for us to get that long-term look, to see portfolios grow, to see the work we do translate into larger dollars in the portfolio, which turns into more spending in the communities, and just great to kind of get that overall impact and see things kind of work throughout a life cycle. We are an independent consultant, and really what that means for us is that we just do one thing. We provide investment advice only, no conflicts of interest across our business. And so what that allows us to do is when we sit down at our investment review committee meetings with the foundation and all of our other clients is just to have really honest conversations about kind of how the portfolio is constructed, what we think, and allows us to bring our best ideas, and our clients don't ever have to wonder if there's sort of ulterior motives or any other reasons for making recommendations. It's a pretty clean and simple business, and our goal really, again, is just to do right by our clients and see those portfolios grow. We do that by trying to align our mission. The mission of the Community Foundation is on the left. The mission of Marquette is on the right. And I think the two together creates a pretty powerful partnership, again, with community foundations, but also our broader client base, just to kind of keep that mission at the forefront. and make sure we're kind of always using that as our North Star as we think about, how that translates to portfolios and markets, just to make sure we keep organizations on track and growing really, hopefully into perpetuity forever. And if you think about, some of the work we do, folks like Evan and his team does a lot of the macroeconomic and quantitative work that we do. But we really are designing portfolios at the asset allocation level. We're not at the kind of security selection level. So it's asset allocation, manager research are the two kind of primary functions. And then a lot of other pieces that go into that, things like client education and making sure that when we make a recommendation, sort of everybody understands the reasons for it and the reasons why. And along the way, we produce a lot of content and publish a lot of research. I think there's a link down at the very bottom of this presentation, which will go out later this week, which allows anyone to sign up for our research if interested, and just kind of speaks to the role of what we do as a consulting firm. So with that, I'll just spend a few minutes talking about the capital markets. Here's our very colorful periodic table of returns. And I'll have you focus on the left-hand side at the moment, which is 2025 calendar year to date through the month of September. So the first 9 months of the year. It has been a very good year across the board. You'll see that by really all of those columns. And this is most of the sort of public parts of the capital markets being positive this year. And most of them are positive to a pretty significant degree. That is not the message that I thought I would be delivering to clients earlier this year. You guys don't have to remember too far back to that kind of late March, early April timeframe when the new administration rolled out really a wholesale change in the way that we think about global trade. And they did it on pretty short notice, and it was maybe a little bit chaotic as far as the rollout went. And as a result, markets sort of immediately started to price in significant volatility. The S&P 500, our large cap benchmark here in the United States, hit almost a 20% correction in a very short period of time, in a couple weeks. And then since that point in time, we've seen a really dramatic recovery. I think that same benchmark is up about 40% since those lows in early April. And as a result, if we look at this blue box here, where the S&P stood at the end of September was up almost 15% for the year. So a pretty significant return so far, with about 2.5 months left to go here in calendar 25. That's coming off of two really good years, the years before. If you look at 2024 and 23, that same benchmark up more than 25% in both of those years. I think a lot of that has been powered by this artificial intelligence theme. We've seen a handful of companies grow at a tremendous pace that has really powered some of those returns. But anytime you look at kind of that environment, you say, all right, well, we had 2 great years and we're on pace for another one. People start to worry a little bit, are we at a market top? Are we due for a correction? And I think those are all very valid concerns at this point, seeing the sort of kind of eye-popping returns we've had over those last few years. It's not just U.S. equities that have been working this year. If you look at the top of this page here, all these boxes in green, these are international equity benchmarks. So for the first time in a while, we've seen stock markets outside of the U.S. actually outperform the numbers we've had here at home. That's a really welcome sight for folks like Evan and I, who build portfolios with sort of, capital market theory at the top of mind that says you should be globally diversified. And for the last number of years, it's really been only the U.S. markets that have been so strong. And finally, we've seen some better results from markets outside the U.S. And then down at the bottom of the page, you don't see quite as strong returns as we wouldn't expect them to be, but all positive nonetheless. The bond market has participated pretty significantly in the rally this year as well. All of the sort of bond market categories are up, between maybe 5 and 10% also. So that leads stocks in the U.S. are up, outside the U.S. are up, the bond market's up, and you'd say, all right, portfolios have had a pretty good year here in 2025 after a couple of years in 24 and 23 that were good as well, kind of after that COVID timeframe. If we back up a little bit and think about kind of some of the reasons why markets have done well lately, and we look at two of the primary macroeconomic factors that the Federal Reserve is also looking at on a very close basis. The first one is inflation. Without question, inflation has come down quite a bit from where it was a couple of years ago in that really problematic kind of 2022 timeframe. But you'll notice on this chart, inflation has not come all the way down. The Fed's long-term target is 2%, And our inflation reports as of late have been consistently closer to 3% than that 2% number. There's also kind of the worry about how tariffs will continue to impact pricing in here. As of yet, we haven't seen sort of major price increases across the board from tariffs. There are certainly some pockets that are affected more than others. But I think this part of the market is worried a little bit about how that will continue to filter through at the prices that we all pay for goods and services around the country. So inflation has come down, but maybe not all the way down to where the Fed would like it to be. The other side of the Fed's mandate is the labor market. And the labor market, I think, has given the Fed cover to start cutting rates here. They had an interest rate cut yesterday, and they did one in the month of September. So we've had 2 rate cuts in the last couple of months, starting to think about maybe stimulating the economy or maybe not being quite so restrictive as to where their interest rates have been over the last few years. If you look at the gray bars on the kind of bottom of this chart, you'll notice the last few data points have not been great. The U.S. economy, from a jobs standpoint, appears to be slowing down a little bit. Now, we don't have real recent data here, and that the government shutdown does affect the release of this data. So it'll probably be a little bit before we see kind of an updated data set or series here. But we can start to use some of the data from the public markets and some of the headlines, like Carrie mentioned at the top, about Amazon and UPS and others, and to suggest that, yeah, there probably is some weakening in the labor market. We're not seeing companies aggressively add jobs at this point in time and are maybe starting to go the other way. So that filters through to the interest rate expectations. The green line is sort of where the Fed funds rate has been over the last number of years. You can see we peaked in kind of 2024 at a little over 5%. And then the Fed has been sort of slowly starting to cut rates here the last year or so. And then they have done a little bit here this year. The dotted line on the right-hand side is where that interest rate is expected to go going forward. And then we got another data point there yesterday where the Fed chair through the press conference said that there may not be quite as many interest rate cuts coming as the market thinks. And of course, we got a little sell-off as a result. But I think we look at that number and say, all right, if we have a short-term interest rate that's around 3% over the next few years, that's a pretty healthy environment. That's a more normal environment. And we think is probably much more sort of supportive of normal economic activity than that environment we had post-COVID, where interest rates were so low for so long, really post the financial crisis, and that sort of zero interest rate environment. And then I think if you look at, the overall factors, there's definitely a little bit of a sort of Goldilocks environment going on. We have a Fed funds rate on the left-hand side that is projected to come down. U.S. economic growth measured by real GDP is expected to be steady, if not rise a little bit. The unemployment rate, even though it's maybe moving up a tiny bit, is still at a very healthy level that looks like full employment. And then we have a little bit of a tailwind from inflation coming down at the overall kind of economic level. Running through a couple of asset classes, we talked about this a little bit already. But if we think about interest rates, what I talked about with the Fed funds is just the very short end of the curve. So the left-hand side of this chart, their interest rates are a little bit higher than maybe where the market would expect them to be. And you can see that by this kind of kink in the yield curve. Normally, we expect to see an upward sloping curve where the 10-year Treasury has a higher interest rate than a 5-year and a 1-year. And we still have this kind of weird environment where short rates are a little bit above maybe where the market expects them to be. And that's, I think, what the Fed is working on addressing at this moment in time. We look at spreads in the economy as sort of a gauge of risk. This is what the lowest quality borrowers in the bond market have to pay above investment grade or above treasuries. And at the moment, not a whole lot of concern in the high yield bond market as far as sort of the ability of those lower quality companies to repay their debt. You can see kind of in the 2022 timeframe, and even earlier this year when we had that sort of tariff announcement in the spring. This is a data series that moves very rapidly when there starts to be kind of concern within the overall market. And today, not a whole lot of that around. There's a lot of optimism, both in the equity market and in the bond market as well. Thinking about equities, this has been a year of new all-time highs. The market has been marching steadily upward since that early April timeframe, setting a number of new all-time highs along the way. which is certainly great to see. It's great to see portfolios grow, but it always kind of brings about that concern a little bit from clients and investors across the board as they wonder, well, hey, is an all-time high still a good point to make investments in the market? And that's where we always remind everyone it really comes down to time horizon. Most of our clients are designed to exist into perpetuity and to be around forever. And so that timing is probably not quite as important when you've got that long of a time horizon as it might be for something shorter. Evan will talk a little bit about more about this in a moment, but the Magnificent Seven companies, these are the largest 7 companies in the US. They have continued to dominate headlines, dominate returns. And while these are all different businesses, Microsoft, Tesla, Amazon, they do different things. They all, to sort of some degree or another, are leveraged to that same theme of the growth and the spending in artificial intelligence. So there's a lot to be excited about in this space. There's probably some to worry about as well. But as we think about these companies and how important they are to the market, this is a large chunk of our overall market. And when we think about returns this year, the reason why returns have been so good is because these companies have been able to grow profits, grow earnings, and grow cash flows at really an extraordinary pace. And they've done it for a long period of time. So, we would say, as a lot of people are kind of quick to draw parallels to the late 1990s period and the tech bubble. At that point in time, a lot of those companies that were generating a lot of return were not generating a lot of cash flow or a lot of profit. And that would be one difference in this market cycle, in that these companies are generating a lot of profit, and they do so at a continually growing rate. We're set to get a number of earnings reports from these companies, I think this week and into next. So we'll get another update, another data point as to how they're performing. But this has been such a big focus in markets this year and really over the last couple of years. It's not all the tech sector. Tech has been one of the best performing this year. It's the largest sector in the market, but it's not all tech. If you look across the sort of sector chart, most sectors have had a pretty good year this year. Things like industrials might not scream artificial intelligence, but the artificial intelligence rollout requires a lot of power. Power requires the data centers, earth moving equipment to build those data centers. There's a lot of knock-on effects sort of throughout the economy related to AI that's not just kind of AI stock specific. And you can see that on the right-hand side in a sector like utilities. It's usually one of the sleepiest sectors of the market, usually not a whole lot of excitement in regulated utilities. But the power demand that sort of is, again, that knock-on effect from this AI build-out has caused kind of all those utility companies to be re-rated. And we think of them a little bit differently now or today than we used to. Outside the US, it's been a pretty good story this year. The US market, for as strong as it's been, has actually been one of the laggards as you look across the global economy. You see a lot of countries dramatically outperforming the United States this year. A lot of that is that those countries and their companies have been doing well. And then a lot of it is also the effects of currency. You can see kind of where this purple line bottomed out. Since that point in time, kind of at the beginning stage of this year, we've seen non-US currencies get quite a bit stronger against the US dollar. As the US dollar gets weaker for US clients that are invested outside the US, that actually creates a little bit of a tailwind. We were able to kind of reprice or convert that currency back to a weaker dollar, and it makes the returns look better. So you look at some of those international countries or current stock market and say, all right, they're up 20, 30, 35% in some cases. Some of that is the performance of the economies and the companies and the markets, but then also some of it is the effect of a weakening US dollar, which as a US investor, we're happy to take, but is the sort of thing that we don't expect to be permanent or sort of to persist. It'll likely sort of flip at some point in time. That said, again, it's not all currency. We've seen some pretty good returns from sectors of the non-US market around the world. One big highlight this year has been aerospace and defense. Certainly, I think this, again, relates to the changing winds of the US political administration and sort of the way that we think about our interactions with the rest of the world. And some parts of Europe have said, all right, maybe some of the onus of global security is now on us. And as a result, we've seen, some spending or planned spending in that space increase. And some of those companies have responded quite positively. So far, I've really just talked about the public markets. We spend a lot of time thinking about the private markets as well. This is an asset class in commercial real estate that has been through a cycle, like a lot of others over the last few years. We do have some commercial real estate in the portfolio. Commercial real estate tends to sort of ebb and flow in these very long-term cycles. We just went through a pretty painful one in the last couple of years as commercial real estate managers have had to sort of rethink how office buildings are used. We've also seen rising interest rates, but it looks like at this period of time, that sort of cycle has leveled out, and we see a little bit more of a stable future for commercial real estate. Infrastructure is another asset class we have in the portfolio. It's an asset class that we like a lot, regardless of sort of what AI is doing. But there is certainly this theme of significant power demands over the next 10, 20, and 30 years to sort of fuel this data center build out that we think provides a nice tailwind to this asset class. It's a diversifying asset class and one that sort of moves in different ways in stocks and bonds. And we like a lot for that reason. And then lastly, private equity. We spent a lot of time thinking about the private markets as well. We expect this to be a big driver of returns in the portfolio. Private market activity has been slow the last few years. Private equity has a lot of debt in the transactions, and as interest rates went up, the cost of that debt got more expensive. It sort of slowed down overall activity in the space. Does look like that's coming back this year. The bar on the right-hand side for 2025 is just through the first half of this year. So if you sort of double that number, it probably puts us somewhere up in this range as far as deal count and deal value. And as a result, looks like 2025 will be a much more a faster pace of deal activity in the private equity markets, which we think is certainly a good thing as we think about getting distributions back in this asset class for clients. So the last few slides for me are just to talk about the community foundation portfolio specifically. We take all that capital market data and sort of distill it into a portfolio and that is well diversified across sectors and strategies and geographies. If you look, this is a little bit of a busy slide, but if you look at the inside of that pie chart, just that center circle, that's the overall allocation that the foundation has. So 18% to fixed income, 32.5% to U.S. equities, 21.5% to non-U.S. equities, and so on and so forth. The outside pie chart is then within fixed income. What are some of the underlying strategies that we utilize? Core would be investment grade, bank loans, emerging market debt, and you can sort of read your way around the pie chart to know that at a high level, it looks like there's 5 asset classes in the portfolio. There's quite a bit more than that. And then outside of the asset classes, I added a few of the investment managers that we partner with on the right and left-hand side of the page. There's the broad asset class, the narrow asset class, and then the investment managers that actually go out and execute on the portfolio. So there are a lot of moving pieces and a lot of parts that sort of flow into that overall portfolio, and just listed out, some of the trusted partners that we work with alongside the foundation to actually go out in those sub asset classes and execute into these categories. The end result is a performance track record. It's a performance-based business that we work in, and our goal is to create a track record that is attractive relative to benchmarks and peers, and at the end of the day, allows the foundation to do and to meet its objective, which is to grow in real dollars so that more money can continually be returned back into the community. Certainly the last couple of years, the returns in an absolute sense have been very strong. Maybe not quite as close to the benchmarks as we would like, is that we maybe don't have enough exposure into AI as we should have. But I think it provides maybe a little bit more of a defensible position when these cycles inevitably turn. And then out to the right-hand side of the page, we're pretty proud of the sort of 7 and 10-year track records that have been built here, consistently above that 7% number, which accounts again for spending, inflation, and fees, and allows for some real growth at the portfolio level. So we measure performance against a benchmark, and then we also like to look at the performance against peer groups. What are other nonprofits, other endowments and foundations doing around the country? And I think for us, this is important in that we know, there are a sort of a constrained supply of dollars that can get donated to various charitable causes. And it's one of our goals is to make sure that the Stark Community Foundation always looks like a really responsible place and a really attractive place for donors to place their money and to build a foundation on a going forward basis. So I will pause there. Again, questions at the end. That was the end of the market commentary piece. And with that, I will turn it over to Evan to run through the impact of artificial intelligence on markets. Like I said before, we spend a lot of time thinking about this. This has been a big dominating factor in markets over the last few years and will likely to be so going forward. So with that, Evan, the floor is yours.
Thank you, Chris, and thank you for everyone for joining today. I'm excited to cover this topic. It's super interesting, and as Carrie and Chris have mentioned today, relevant as well for everyone, not just us in the investment world, but folks across the country. So I thought it might be helpful to kind of begin this portion of the presentation with some information related to the evolution of artificial intelligence and what AI tools can do today. So as you can see here, AI has a history that dates back about 100 years to the 1940s, when the US and England and the Allies were using the first digital computers to break some of the German codes during World War II. That kind of represented the birth of what the people refer to now as thinking machines or some of these AI programs. And then in the 1950s and 60s, researchers developed programs that could reason and communicate in simple ways. And then after a period of sort of negligible progress, which is referred to as the AI winter in the 70s and 80s, we saw research pick up again in the 90s. And of course, into the new millennium, thanks to more data and faster computers, more improved algorithms, et cetera, AI tools began achieving pretty significant breakthroughs in things like image recognition and translation around this time. And then fast forward to today, so AI models are incredibly sophisticated and being integrated into almost every industry, from healthcare to finance and entertainment, et cetera. And we'll talk about, exactly how those industries are implementing these tools in a minute. But the upshot here is that in less than a century, AI has evolved from sort of a theoretical idea or concept into a powerful and applicable force shaping the way in which we work and communicate with each other. And this evolution is expected to continue over the coming years and beyond. So this is a really interesting and helpful visual that shows how artificial intelligence has advanced to match and in some cases even surpass human performance in key areas. So you can see that it was well below human capabilities in things like reading comprehension, handwriting recognition, et cetera, in the late 90s. But AI systems have improved steadily since then, with major breakthroughs again coming in the last 15 years or so. And by 2016, so about 10 years ago, AI has surpassed humans in things like image and handwriting recognition, and then in subsequent years, things like language understanding and processing, speech recognition, et cetera. And today, these systems continue to outpace human performance in most of these key domains. And I think this illustrates just how quickly machine learning and deep learning have transformed what technology can ultimately do. So I alluded to this idea earlier, the idea that various industries are integrating AI tools. Here we can see kind of those broad applications and how they're being implemented across industries. So for example, in healthcare, AI is transforming things like medical imaging and drug discovery, which helps detect and prevent diseases earlier and develop new treatments. You move on to, the retail and e-commerce space, as I'm sure you're all aware, it's behind things like product recommendations, even consumer and customer service. Chat bots are powered by AI, things that kind of help personalize the online shopping experience. In entertainment, AI curates content on platforms like Spotify and YouTube. I'm sure you've all heard about the algorithm that is personalized to each individual based on their viewing or listening history, and it even works to generate new content in some cases. So there are AI bands creating new music. I'm not sure it's all of the highest quality, but it's certainly a fascinating idea, and the list goes on. I won't go through each one of these here. So again, the takeaway from this one is that AI is reshaping, or at the very least, I would say augmenting nearly every part of the global economy. So one of the most interesting things about AI tools is just how quickly they've been adopted by the public. So you can see here that ChatGPT, which is the online kind of chatbot slash AI assistant that a lot of people use, reached 100 million active users in just 2 months. And you can see from this graph that that pace far exceeds that of, things like TikTok, Instagram, and Spotify, which are very popular apps, but they took years to reach that same milestone of 100 million active users. And I think this idea kind of reflects how accessible but also intuitive these AI tools have become. Everybody can use them. Everybody knows how to use them. And there's, of course, an enormous public interest in using them for everyday tasks like writing, research, and even some creative endeavors as well. And I think, again, this is a sign of just how transformative this technology has been and how quickly it's being integrated into our daily lives. So I mentioned, the public is integrating these tools. Companies across the globe are doing the same thing. So over the past few years, the percentage of businesses that are integrating AI into their operations has increased significantly across pretty much every region of the globe, to the point where roughly 80% of countries, that is, around the world are utilizing AI in some form or fashion in their daily operations. North America and China have shown particularly strong growth of AI integration, but we're also seeing meaningful adoption in places like Europe and the rest of the Asia Pacific region. So AI is certainly becoming a core part of business strategy worldwide. So here we kind of double click on one industry specifically, which is the asset management industry, particularly relevant for the folks on this call today. And we examine just how exactly firms in that space are integrating AI tools kind of across their investment process. So when we think about the asset management industry, we're talking about firms that are basically money managers who run the funds that Stark has in its portfolio, that list of firms that Chris had a couple slides ago. And we can see from this data that many firms in this industry have already adopted AI for functions like generating investment ideas, analyzing market indicators, and incorporating alternative data sets. And many firms in this industry that haven't fully integrated these tools into their processes have either partly integrated or planning to integrate AI in the near future. So this suggests to me that AI has become a critical component of modern investment manager strategies. As for us, so Chris, detailed this earlier, we're a consultant. That's quite different from an asset manager. But even we've started to integrate AI into our daily operations as well. So for instance, we've started using a tool that can help scrape client account statements and other documents for relevant information to help make data entry more efficient for our performance analyst team. Obviously, we still have folks kind of on the back end checking the output and ensuring accuracy, to be clear. But that's an example of something that we weren't doing when I started the firm just 5 years ago, that makes our operation run a little smoothly, I would say, today. Okay, so that's the background on AI and the extent to which it's being utilized. Now we can look at how the rise of AI has impacted the equity market specifically. And here we can see just how dramatically stocks that have been tied to this AI theme have outperformed in recent years. So over the last, call it 5.5 years, the Magnificent Seven, again, those mega cap tech companies like NVIDIA, Amazon, Tesla, et cetera, have delivered returns of more than 540% on a cumulative basis, again, since the end of 2019. Each of those companies is directly linked to AI in one form or another. And then Bloomberg developed its own AI-oriented index, which is basically just a basket of 50 companies most exposed to the AI theme. That index is up more than 260% over this period, and those returns, as you can clearly see, have far outpaced the broader global equity market as measured by the MSCI ACWI, that's U.S. and non-U.S. equities, over this time period. And this kind of underscores, again, just how AI leadership has become a key driver of market performance and investor enthusiasm. And here we highlight just how much AI-oriented sectors have driven market performance over the last, call it 5.5 years. So since the end of 2019, the information technology sector of the S&P 500 index has accounted for roughly half of the total return of that benchmark. That means that much of the market's gains have been concentrated not just in a single sector, but in a small group of companies that have benefited from this theme. And you can see that other sectors such as communications and consumer discretionary have also contributed to returns in a meaningful way. Those are also spaces that are perhaps more indirectly, in certain cases, directly linked to technological innovation. So it's clear that AI has been the dominant engine spurring market growth in recent years. So Chris kind of alluded to this with strong performance typically comes elevated valuations. We've definitely seen that for AI-related companies relative to the broader global market and on an absolute basis as well. So here we can see that Bloomberg AI index, it trades at much higher multiples across pretty much every measure, including price to earnings, price to sales, cash flow, et cetera. So essentially, investors are paying significantly more for one unit of earnings for an AI-related business versus your average company. That, again, reflects strong investor optimism and enthusiasm related to AI's long-term potential and the belief that these companies will continue to drive technological and productivity gains, but it is worth noting that these high multiples leave little margin for error. So future returns are going to depend heavily on whether AI adoption continues to accelerate and whether these companies can translate innovation into sustained profit growth. So in short, the market is clearly pricing in a very optimistic future for AI. And if that doesn't come to fruition, we may see some pretty significant re-rating here in the coming quarters. So that may beg the question that Chris kind of posed, a few moments ago. To what extent does the current environment mirror that of the late 90s, during which we saw, again, years of very strong performance from tech-related companies, followed by the bursting of that tech bubble? And at first glance, these two periods might look similar. And sure, it's probably safe to say that, even today, that there are pockets of what I would call speculative excess across capital markets, places like cryptocurrency, meme stocks, et cetera. Those things kind of rhyme with what we saw during the tech bubble. But as you can see here at the equity index level, things are a little different. So in the tech bubble, which we show in the bottom chart, the NASDAQ, which is sort of a proxy for tech stocks, soared, obviously, in the years leading up to the new millennium. But you can see that earnings for that index barely moved during that time. So in other words, valuations were driven almost entirely by investor hype and enthusiasm rather than by underlying company fundamentals, which are better long-term predictors of viability. But in contrast, the top chart shows kind of today's rally in artificial intelligence companies, and that has been accompanied by the strong earnings growth that Chris detailed earlier. So this suggests that unlike in the 90s, today's market strength is at least more supported by real measurable profits and not just speculation. So while valuations are indeed high, they appear at least to rest on much sturdier foundation in terms of corporate earnings and fundamentals. So really quickly, this chart just kind of double clicks on the idea of strong earnings growth for AI-related companies, which again has consistently outpaced the broader market in recent years. You can see that both the Bloomberg AI Index and the Mag 7 has posted much stronger earnings gains than the global equity market since 2019. Looking ahead, analysts largely expect this trend to continue with AI-linked companies projected to maintain faster earnings growth both this year and next. Again, just kind of reinforcing the idea that this AI rally is being driven by strong fundamentals and not just investor sentiment. This slide highlights the massive CapEx programs that firms are undertaking in order to hopefully deliver on those growth expectations over the coming years. So here we show the Mag 7 companies specifically and alone are investing hundreds of billions of dollars in AI-related infrastructure and initiatives, with spending expected to rise significantly in the next year or two. And these numbers don't include, obviously, CapEx from other firms or government subsidies aimed at spurring continued AI innovation. So obviously, companies are, I would say, singularly focused on further development of these technologies and pouring massive amounts of capital into the space as a result. So here we show sort of what might be at stake for some of these AI-related companies over the next several years and why they're so focused on these CapEx programs and why the market is so focused on these companies. And that's the total revenue tied to generative AI technologies and the projection for that. So as you can see here, it could reach about $1.5 trillion by 2032. And that's according to Bloomberg. So a potentially massive market over which these companies are now competing. Obviously, a lot has to go right from an innovation perspective in order for those estimates to ultimately come to fruition. But clearly, there will be a lot of gains to be had by the companies that are able to position themselves correctly over the coming years. So Chris kind of talked about the rise of data centers. I'm sure you all have heard about those. They're basically facilities that house these servers and systems that store and manage the data used for some of these AI systems, and they enable the computation that's required to train and deploy the AI models effectively. Some of these things are absolutely massive and take up millions of square feet. There's actually an interesting visual of, I believe, a Meta data center overlaid on the island of Manhattan, and it takes up basically the entire thing. It's a crazy visual. But anyway, as you can imagine, these data centers require massive amounts of energy in order to run effectively. And here we can see that as AI workloads expand, especially among those big hyperscalers and larger enterprises, energy demand is expected to increase sharply as well through the end of this decade and beyond. Some estimates suggest that around 750 billion in new grid investment may be required within the next 5 years to support this growing power demand. And so basically this underscores not only the growth potential of AI, but also the infrastructure and the energy related challenges that come with scaling such technology. So a lot of these slides have been focused on public market dynamics. We wanted to spend a little more time on kind of private markets to round things out because that's where a lot of this innovation is taking place. Companies like OpenAI, Anthropic, Databricks, et cetera. And this slide shows how venture capital activity in the AI space has surged in recent years, as you can imagine. So right now, about a third of all VC deals are tied to AI and machine learning companies in some way. And what's especially notable is that the deal values have accelerated much faster than the actual deal counts, with nearly 75% of total deal value in the VC space now linked to AI-related companies. So this dynamic, I would say, is similar to the trends that we're seeing in public markets in that it reflects the kind of rising valuations and investor enthusiasm in the space. And then sort of like moths to a flame, we've seen explosive growth in AI startups over the past decade with hundreds, thousands of fledgling firms coming online each year. The US continues to lead in terms of new company formation, but we're also seeing meaningful growth across Europe and China as well. Obviously, the vast majority of these firms won't be ultimately successful. That's just kind of the nature of startups across any industry. But it is interesting to see the extent to which entrepreneurs have kind of embraced this theme as well. Probably doesn't hurt that the startup costs of AI businesses now aren't super excessive, right? You really only need a computer. Scaling the business is obviously a different story, so that's probably contributing to some of these numbers here. But certainly interesting to see so many new AI companies coming online each year. So the last few slides we have in here are sort of the key takeaways that we have for organizations like Stark and others with investment programs. Here we have the ways in which investors can gain exposure to the AI theme. You can see that there are several here. So the first one we have, investors can invest directly in individual companies that are using or developing AI. That can be done within public markets or private markets via co-investment programs. There are also AI-focused ETFs and mutual funds that provide that kind of direct thematic exposure that's more diversified across different AI companies, diversified in quotes. Venture capital and private equity funds, obviously those offer opportunities in early stage AI businesses. There's the option to invest in the AI infrastructure like cloud centers and data providers and that sort of thing that help kind of support the backbone of this AI technology. And then finally, broad market indices like the S&P 500, as we'll see, I believe on the next slide, already provide meaningful AI related exposure. So we can see that here. Yes, so we can see the sector exposures on the slide for the S&P 500 as of a couple of months ago. The darker shades of brown represent kind of, in our view, the sectors that are most tied to the AI theme. And so we can see just how deeply embedded AI exposure is in today's stock market. So information technology and communication services alone make up about 40% of the index. And then again, these are data points as of 6:30. It may even be higher now. But if we look at the top 8 companies in the S&P 500, so that's NVIDIA, Microsoft, Apple, Amazon, Broadcom, Meta, Google, and Tesla. Those companies make up over a third of the index. I think NVIDIA over the last couple of days is now close to 9% of the index with just one company. It's crazy. So equity markets are top heavy, at least here in the States. And that means that, even passive investors, folks that are just direct investing in an S&P 500 index fund, are significantly exposed to AI. This goes back to the earlier point we were making about AI driving kind of broad market performance in recent years. And as we look to the future, I think it's safe to say, at least to a certain extent, that as AI goes, so will go the broad market, kind of given these exposures. And that's kind of a nice segue into the risks of AI. We haven't really talked a ton about these, but I think it's definitely important to kind of hammer these points home as we round out here. So we don't have market concentration on here, which I just discussed. That's certainly something we're keeping in mind. We discussed the higher valuations at which these stocks are currently trading. Certainly more expensive stocks are more susceptible to market volatility and shifts in investor sentiment. There's also significant regulatory uncertainty surrounding these companies as governments consider new rules around AI use and data privacy, et cetera, as well as the extent to which some of these larger businesses may be engaging in monopolistic or anti-competitive practices. On top of that, there are obviously limitations to these technologies that we may be bumping up against in the near future. Capital intensity, high capital requirements that are required in order to scale some of these businesses. And you even have the possibility of political pushback and backlash over the job displacements that Carrie and Chris discussed earlier that might arise as a result of these advances in AI. We've also, already kind of seen a little bit of that. To what extent will that continue? We'll have to see. So all of these, I would say, are factors that investors need to kind of carefully weigh and balance with the opportunities that AI investing presents that we discussed. So let's kind of bring things home here with some of the key takeaways related to the AI investment landscape. So first, AI capabilities have advanced, as we discussed, at a very rapid pace over the last decade and a half, with breakthroughs in Gen AI and machine learning kind of driving adoption across a variety of industries, and then those massive capital expenditure programs by tech companies that continues to kind of fuel this growth. But risks like index concentration and higher valuations mean investors should be mindful of the potential downside if current growth expectations aren't realized. But overall, and kind of unlike in past cycles, I would say that today's AI leaders, so kind of those big companies, are supported by real revenues and practical sort of proven applications. So I think that's all I have. Chris, I don't know if you wanted to add anything. Otherwise, Carrie, I'll turn it back over to you.
Yeah, yeah. Thanks, Evan. That was great. The one thing that kind of strikes me, and I think it was, I don't know if I'll find the chart here real quick, but it's just the speed of adoption. So, I mean, you look at some of these charts and like the reading comprehension sort of starts from nothing and increases above humans in just a short period of time. But I think the important thing here is like, and you kind of touched on this slide a little bit, this has been going on from like a research standpoint for a really long time. And it really just sort of hit the public consciousness, like what, in 2022 or 2023, when we had the Chat GPT moment, when like that was released, that's when it really like everyone became aware of it. But the technology here has been in the works for quite a long period of time before that.
Evan, we do have a question here for you from one of our attendees, and you talked a little bit when you talked about the risk of AI and any concern that AGI and or super AI will not be properly aligned with human values.
Yeah, I would say there are concerns about that. I mean, value, different people have different values, so just determining what human values are objectively, I think is difficult. So that's problem number one that we have to solve. I think, thousands of years of human civilization, we still haven't answered that question. But as it relates to, AI and human values, I do have concerns about that. There were a couple of cases actually that I read about, and not to get too dark here, but I think it's important to make the point. So, people who have been experiencing kind of mental problems or suicidal ideation have turned to Chat GPT to kind of, ask about those things and what should be done. And in some cases, individuals have ultimately kind of taken their own lives, potentially as a result of the feedback that they got from Chat GPT. So this technology is still in its very nascent stages. And as we grapple with, human values and how humans should be interacting with Chat GPT, I think we have a long way to go to kind of resolve some of those issues. We're certainly not there yet. And I would guess it'll take a lot of years and a lot of kind of discussion in the public square about what values an AGI should ultimately have. But it's such a difficult question. Chris, I don't know if you have any thoughts on that.
Yeah, it's definitely a big one. And then, I think too about, different geographies and different parts of the world and different governments. And, there's definitely competing interests in other parts of the world versus what might be good for the US might be different from what's good from China. So, yeah, I think there is already a race to sort of build these, because if one country gets kind of too far out ahead, that becomes maybe more widely adopted and it may not align with the citizens of that country. So there's a ton of really interesting and potentially problematic things to unpack there.
And I worry too about kind of echo chambers, at least from, there's values, but there's also politics. I guess they kind of go hand in hand, but we've kind of seen, I won't call out any specific companies, but I think some companies with founders that maybe have a certain political ideology, if you use those technologies, you might see that reflected, right? So, maybe certain people on the left will be seeking out AI technologies founded by someone on that side, and someone on the right might be going in a different direction. And, these kind of echo chambers that we're living in now, that we're seeing online and on the news, et cetera, we might see that with AI, which is a scary thought that we might be, even further divided as a society as a result of these tools. But I think that's a distinct possibility as well.
And, I think nothing makes you feel older and hearing about the potential of AI, right? And, not all of it's about layoffs, because I'm assuming there's going to be new jobs generated to work alongside AI, but is there going to be that skill, set? Are we going to see a gap in, those new jobs are created? I don't know if you guys have any thoughts on that. The people that are getting laid off aren't necessarily the ones that might be able to work alongside AI, because they just don't have the skills to do that.
Yeah, I'll start, and then Chris, I'd be curious to hear your thoughts. I would call myself an optimist. I mean, when the internet came along, I think folks were worried about kind of massive disruption. You're always worried about massive disruption as a result of new technology. There's the fear of the unknown, fear of uncertainty. I think humans are pretty resilient. When the internet came along and has turned into what it is now, we haven't seen massive cataclysmic labor market disruptions. People have maybe moved around. The labor market looks different now than it did in the 90s. But I think people are generally pretty adaptable. And like I said, these tools are pretty easy to use, right? ChatGPT is easy to use, so you can incorporate them into your daily lives and daily work lives pretty easily as well. So maybe I'm a naive optimist, but I don't know. That's my take. Chris, do you want to balance that out with some pessimism?
No, I'll take the optimistic route too. I mean, I think you've seen a lot of technological cycles probably over the last 100 years where everyone was always worried about that. This one maybe a little bit more so because it has the ability to sort of replace some of that human level interaction that you mentioned. I think so far, I think some of it could just be that we've seen so far, like the recent Amazon stuff and UPS. Some of it might just be these companies right sizing a little bit in the wake of COVID. I think those two particularly hired a lot after COVID, and this might be a convenient excuse to back off from it. I read something the other day that there was an engineer working at Amazon that originally there were like 4 managers between him and Jeff Bezos, and now it was like 28 levels of management between him and Andy Jassy, the CEO. So some of it might just be there's a lot of folks there that maybe are duplicative and maybe they're just trying to right size a bit. We'll see kind of where it goes from here. But the early stages could just be some cover to use AI as a convenient excuse to lay some people off.
Yeah, and that's a good point. I mean, especially with the Amazon, I think that always shakes people to the core a little bit when you hear them point directly to AI. A lot of times, layoffs are just cost cutting. But you're right. Maybe they're capitalizing on an opportunity to do some cost cutting. So
yeah, and the first round at Amazon was in the warehouse. It was, now I think 75% of their factory, the factory floor, the warehouse floor is automated. Now it certainly it feels a little different because these are now white collar jobs that are getting, displaced. But it's definitely going to be the theme as we go forward.
Yeah. Well, Evan, thank you for the AI. Chris, I do want to ask one question maybe on your side of the presentation, just in regards to, the rate cuts and, the feds have the 2 jobs, control unemployment and control inflation. And we know right now those 2 things are kind of counterintuitive to each other. Is there ever a point where one trumps the other? So like if we continue to see layoffs like this, but inflation continues to stay a little bit sticky, will that still drive them to cut rates?
Yeah, the question you ask is sort of the concept of stagflation, where you have declining growth but increasing inflation, and that is pretty problematic because then you wonder which one trumps the other. And I would say it sort of depends on the data series. If you see unemployment, 4, 5, 6, and it starts to accelerate up from there in kind of that 8 to 9% range where we were during the financial crisis, certainly the economy becomes and the job market becomes front and center. And conversely, if you've got inflation running in that, kind of 2022 range where that might be around 8 or 9%, I think inflation takes the cake. So it's probably just a matter of balancing like which one seems worse at the moment. And I think, 2 or 3 months ago, inflation was the concern because you had that higher inflation, but these jobs reports were still pretty good. All of a sudden, like in that middle of the summer, we got a few jobs reports that weren't great. And I think that gave the Fed cover to start to lower rates because, I think from this market slide, the market would still tell you that short rates are higher than where they need to be like neutral. So we're still sort of maybe in a little bit of a restrictive area, which is why they're I think today more worried about the labor side than they are the inflation side for the moment.
And maybe one more we got a few minutes here. One more quick question. The government shutdown. I know you talked a little bit about that and the impact it has on the data coming out. But what do you guys feel about the impact? I mean, we haven't really seen much economy market yet. I think we're 30 days in. The longest has been either 34 or 35 days. Is there any thoughts around that? And if this continues to drag on, what we're going to start to see here?
Yeah, that's another good one. I think last time around when it was the 35-day one, it was like the TSA agents stopped showing up for work, and that's what got the politicians to get their stuff together. I flew this last weekend, and the airports are pretty clear, so it doesn't seem like we're going to get the TSA stress just yet. But yeah, I think the longer that persists, it probably I think the first thing that we're worried about is the data. I think the Fed right now is really data dependent. Everybody is kind of always looking at this data, and you're starting to see some of these data series, evaporate where you just don't get that same quality of data. So a little bit flying blind. I think it probably takes quite a bit longer for it to really start to impact like true fundamentals of the economy, because so much of it is still on the corporate side. But don't forget, I mean, the government's the largest employer in the United States, and the more people that stop getting paychecks, on that side or are furloughed, it's going to have a dent at some point. I don't know, Evan, you have any thoughts other than that?
I would tend to agree. I think maybe the TSA of this go around might be the SNAP benefits, those food assistance benefits that are slated to expire, I believe, on the 1st of November. So in a couple days, we're talking about 40 plus million people, children, senior citizens, et cetera, that might not have access to food. I'm no sociologist, but I feel like that might be a problem and create some pressure politically for folks to come to the table and get this resolved. So that might be the thing that gets people to the table. But your guess is as good as mine as it relates to when this is ultimately resolved.
Okay, well, we are just about out of time. Chris and Evan, we certainly thank you for the valuable information today. And thanks to all of our participants for taking the time to join us. We hope you got some valuable information out of this presentation. Just a reminder, it has been recorded. So the recording and the slide deck will be emailed to all participants within the next day or so. So other than that, if you have any questions for Stark Community Foundation, please feel free to reach out to us. But thanks for everyone today. And we hope you have a great rest of the day. Take care.
Thank you.
Thank you. Good to see everybody.
Thank you.
Bye now.
Bye.